Why don't you walk us through your favorite tax saving strategies, any recent tax changes you think we should be aware of?
One of the most overlooked tax strategies or tax benefits is the health savings account. It is the one of the only investment vehicles that the government allows to be triple tax free. So that means money going into it is a straight reduction off of your income. You can contribute for this year as a family up to $7,750 for 2023. That is.
Mhm.
Uh, the money goes in is a reduction on your income. You can invest that money. I don't think people realize you can invest money within an HSA into
Right.
stocks and bonds, into you can even what's called self-directing it and buy real estate in
Wow, I
your
didn't know that.
health savings account. Cryptocurrency, whatever you want to invest in.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and I'm here today with Mike Metzger, certified financial planner and founder of LifePoint Financial Design. Mike's not your typical financial advisor. He works primarily with high-performing realtor superstars from across the country. He's a real estate investor himself, and he helps clients with building their real estate portfolios, doing portfolio analysis, proactive tax planning and strategies, and helping them create passive income to escape the rat race, which of course is where your passive income exceeds your expenses. And that's where we all want to live, because that's where true freedom is. So Mike, I am super stoked to have you, my friend. I think we're going to have a really interesting conversation here. So how you doing today, and what's exciting in your life?
Yeah, well, I appreciate you having me on the show. I'm doing great. I started my day similar to your morning routine, which I've seen on your Instagram post. So it's a 5 a.m. wake up, mobility, and then an exercise, and then workout, and then meditation. So I
Oh,
don't have the cold plunge, but it started that way, and so that always makes my day great, especially after a Super Bowl Sunday.
that's right. We all needed to get back to a heavy dose of reality. And for me, it's intermittent fasting today.
Oh, nice.
Well, it's funny. Do you know who Jonathan Roach is, Mike?
I don't. Uh-uh.
He is a he is a uh, long distance super marathon runner with a crazy sports background. He started coaching us all around mindset. And one of the things that he talks about, he was just coaching our teams last week. One of the things he mentioned was, look, this is a tough industry right now, meaning mortgage, real estate, the housing market. And it's never been more important for you to show up as a 5 out of 5 in terms of your energy. And if you're showing up each day at a 3 or less, you're really just, you're going to be ignored by the market. You are responsible for showing up and doing the things you need to show up as a 5 out of 5 every single day. And obviously, our morning routines are absolutely key to that.
Oh, I would 100% agree. I mean, the way you start your morning is the way you're going to set the tone for the rest of the day. So if you don't set that tone intentionally in the morning, then the rest of the day can get away from you pretty quick.
That's right. You either set that tone or the world's going to set it for you. And I'd rather have agency over setting the tone.
Exactly. Exactly.
Awesome, man. Well, hey, tell us just a little bit about your background, how you got started working as a financial advisor, your interest in real estate, and then also your kind of focus on helping realtors.
Yeah, sure. So I've lived everywhere around the country and around the world actually when I was a kid.
Cool.
I've lived in eight or nine different states and one different country, and I ended up spending most of my life in Iowa, and then I went to the University of Iowa. Well, when you live in Iowa long enough, you certainly want to get to a place that's not so cold 9 months of the year. So I ended up moving out to a place called Santa Barbara, California. And if you happen to know Santa Barbara, it's like heaven on earth. And
Spectacular.
so I went and I looked for any job that I could, and it happened to be in the 401k department of a payroll company. And that was really kind of the start for me of getting into the career that I did. And then that transitioned me to Merrill Lynch. And then I was with a large West Coast bank brokerage for a while before starting my own firm in 2018, which is solely focused around real estate professionals. So the only financial planning I do is just for real estate professionals. And a lot of times that's real estate investors. I work with a lot of real estate agents as well. But the way that journey happened is quite interesting in how I got into the real estate space. I had worked for Merrill Lynch at the time, and I came across, I was fairly new, and I partnered with one of the sort of the main guys there at the firm. And I came across this prospect. They had lost their house in a fire. It was just a California wildfire, and unfortunately, it went through the entire neighborhood, and they lost their house. Well, they got the insurance money X amount of years later, and she had come to me with this is multi-millions and wanting to potentially invest those funds. So I bring her to my partner at the time. And she was contemplating on whether to put that money into a real estate investment or a couple of real estate investments. And at this point, I'm living in San Luis Obispo, California. It's a college town. And so she wanted to invest in college rentals.
Mm.
And of course, the way that worked with a 30-year, main guy partner at the firm was, well, it was kind of an all or none. You're investing it all into the stock market. And that's what we're going to do. Anything else besides that is foolish. Of course, that person walked away because she didn't see the sense in that. Yep. And it got me thinking about why that couldn't be a possibility. I mean, real estate is still an asset class. And so and the numbers that she was throwing out and the possible income was terrific. So this is sort of a culmination of events that led me to it. I was then with the large West Coast bank brokerage. I was doing financial planning. I'm a certified financial planner. So it's more about the planning and the strategies as opposed to investing funds, although that's a portion of it.
Right.
But I started to notice that the clients who had less money, presumably, less retirement assets, and then they had real estate investments, and they managed the expenses that they were living off of. Those people's financial plan ended up being significantly more successful than the people that were coming to me with $5 million in a 401k.
Interesting.
And I didn't really know that was going to be the case. You run these numbers, and $5 million man has 50% chance of having enough money to last him the rest of his life. And then you have the other person with a few rentals, modest expenses, and they had 100% chance of success. And so it really got me thinking and diving into it. And then you fast forward a little bit later, my wife's actually a realtor as well. And so I just started clicking, and I invested into real estate myself, and the rest is history.
Yeah, you alluded to the mentality that I call binary thinking, and I've caught myself in this binary thinking a lot of times, and it's a trap that I'm now aware of that I try to pull myself out of. And what I mean by that is, hey, we have to be all index funds all the time, or we have to be all real estate all the time. And if you think about it, most investors are that way. This is my lane. I just do this. Or real estate folks will say, I don't trust Wall Street. I just do this. Mm-hmm. Another set of binary thinking that I catch myself in is, okay, I've got some capital here. I need to put all my capital at play. Instead of, well, perhaps I could put a third of it or half of it, or I could do these three different things. And so you just mentioned that financial advisors tend to be the same way, right? They just stick in that lane. It's a binary thinking, but diversifying across those two different asset classes is super valuable. I want to dive into that just a little bit more. Like, when you're helping a client create an ideal portfolio, what does that look like as it relates to the proportion of perhaps real estate, bonds, stocks, other investment vehicles?
Yeah, I would say first, there really isn't an ideal portfolio. And I'm just going to preface that with the sense that everybody has a different goal, an end goal of what they're trying to get to. So a lot of the times when I'm working with clients, the question that I ask in the very beginning is, what does life at perfection look like to you?
I love that.
There is a variety of answers, I mean, you have to really think about it. What does your ideal life look like? What would you do in that ideal life? Well, some people might say, well, I'd have a really big house. Other people might say, I just want to be able to pick up and leave and go on vacation whenever I feel like it, or have the ability maybe to take care of my parents because, they might have aging parents. And so everybody's story is completely different. From there, you build out what that portfolio is going to look like. But yes, in all circumstances, diversifying the the avenues of where you invest your money is always going to be a good idea. So um, a lot of the times, especially with like real estate investors, I want them to look at investing into things like a solo 401k or some kind of a retirement account. I want them to look at that not necessarily as stocks and bonds, but to look at it as helping their overall financial picture. And that can be a lot of times because of the tax savings involved in it. So if you're having a high income year, if your real estate is producing a lot of income, you do need places to shelter that money. And that money that's in the retirement plan isn't stuck there forever, because I think that's another false misconception about retirement plans is, well, who knows if I'm going to be alive by the time I use that money? And that's a valid concern. But that money isn't trapped in there. You can slowly, during appropriate times, convert that money out into things like a Roth account. And in a Roth account, you can actually take your basis out of a Roth tax free. A lot of people don't understand that. So, there's going to be a diversified approach, but no, generally all stocks and bonds, all real estate with no liquidity is not going to be the best place.
Yeah. Yeah. On a previous podcast, I've talked about this before, but my grandparents were that way, where they were all land and all investments such as apartment buildings, and they hit a rough patch. There was a recession. There was a period where there were a couple of different liquidity events that happened at the same time. And as a result of that, and the fact that they didn't have diversification, they ended up selling a piece of property back to the realtor who sold it to them originally. And then that realtor turned around and sold that property 90 days later for $1 million higher price. And
Wow.
it became a major, he sold it to Hilton Hotels. And I bring that up because had they had a little more diversification and a little bit of money stacked away other than in real estate, they would have been able to handle that liquidity crunch, and it would have been a lot less of an impact to their overall financials. So for clarity there, when you're advising most clients, are you advising them then to put some of their money into stocks and some of them into index funds, or what might that look like for an average client of yours?
Yeah, it's going to be different, but the average client, I would say, we take a look at their overall liquidity that they currently have. Of course, we want them to have, especially as like a real estate investor, business owner, we want them to have a certain amount of cash in liquidity, right? So we're going to look at what we call their liquidity score. So these are just like financial health checkups that I do on clients. Let's take a look at your liquidity. Now we have this liquidity. It's at the end of the year. Do we want to put this money to help you? Do you need to save on taxes this year? Are you going to need to save on taxes? Well, then let's put that money into, say a retirement plan. But for most real estate professionals, putting money into a retirement plan versus putting money into a real estate investment is the exact same thing for them. It's a dollar for dollar reduction off of their income. So we're probably going to look at what's that balance that we want to strike between putting it into, traditional diversified investment portfolio of stocks and bonds. If you're younger, then probably more stocks than bonds.
Yep.
Versus can we pick up an additional property? And is this the appropriate time? I think our conversation is probably going to lead there, but I think right now we're gearing up for a really great opportunity in real estate. And so I might be saying to them, let's just keep that money to the side so that we can put that down on a new investment property. And, then we would get into conversations about what kind of investment property and where specifically.
Yeah. So it sounds like to me, Mike, your first consideration is liquidity and tax efficiency. And then from there, you make the right decision from that standpoint.
Exactly.
Love it. Well, cool. Let's move into that next point that you were alluding to. It's my belief that we're nearing a turning point in residential real estate. In fact, I believe we've actually hit a turning point. Inflation peaked in June. We've seen mortgage rates kind of peak shortly thereafter and start to go lower. As mortgage rates continue to follow inflation lower, I believe that's going to bring about more housing affordability. We're going to bring a lot of demand that may be sitting on the sidelines that is not attracted to a 7% mortgage rate, but 5% sounds pretty good right now. So as we get closer and closer to 5, I think we're going to bring some people into the housing market in terms of buyers. But I'm just curious, how are you kind of seeing the real estate market? What are you noticing, and what kind of trends are you watching?
Yeah, I think as you just alluded to, I do think we're entering into a really, really great time for real estate investors and anyone in general who's looking to get into the real estate market.
Yep.
We're at this inflection point of interest rates are high, inventory has been sitting, but we know that the Fed is already slowing down the interest rate hikes.
Yep.
And very likely, and they've already hinted to the fact that they're then going to be reversing that and taking down the interest rates. And so at that point, that's when they're trying to increase demand again, right?
Yep.
And so the demand is going to pick back up, but we're going to then probably be getting into a period, if you wait too long, of this bidding war again, and then having to drop the inspections and all of the other things that aren't necessarily advantageous.
Right.
And so the trick for real estate investors is getting there on the cusp of that before it gets to the bidding wars. Yeah. And so in over the next 6 months, I think it'd be a really great time. You can always refi out. So if they're at 7% rates now, and they're going to get down to some expectations, like I think CoreLogix and a couple of the other economists out there think that rates are going to get back down into about 4.5%. And they're
that's Fannie Mae's projection as well.
Okay, yeah. So you get in at 7% 6 months later, and we already went through one of these periods just recently, but 6 months later, then you can refi out at a much lower rate, 4.5%. I mean, 7% is historically low. 4.5% is all. We're not going to get into twos again. So I think a lot of people need to get that out of their head. Two is not going to happen again. I fortunately got a refi at 2.5%. I think that was near the bottom. Yeah. But again, 4.5% is going to be terrific. You might want to move before it gets to that point, because it'll be a crazy market when that happens.
That's it. And we're already seeing that. I'm hearing some of our teams in Colorado, in San Diego, in SoCal, all saying, "Oh my gosh, we're back to multiple offer situations." I was just talking to one of the top real estate brokers in Salt Lake City, Utah, that I should introduce you to, my good friend Jake Breen, and he went through weekly under contracts in Salt Lake County. And the numbers he was giving was, all right, if we start back in January, there was about 100 under contracts happening a week. Then as we moved to the later part of January, that moved to 200. And he just gave us the last 2 weeks numbers went to 300. And I think he said 400 under contracts. So you've got a quadrupling of the number of homes that have gone under contract in the last 6 weeks. So it's happening, man, right now.
Yeah.
It is, that curve is happening. So there's this saying, Mike, that I heard, and I wish I could remember who to give credit to for this, but it goes something like this. I buy houses, real estate investment houses, where it makes sense, meaning financial sense with cash flow, so that I can choose to live, or I can afford to live where it doesn't make sense. And I think that's kind of an interesting place potentially for us to talk about, because prices are still definitely high in the coastal areas and some of these crazy high demand areas. How do you help people that live in places like Santa Barbara identify cash flow friendly places to be a real estate investor?
Yeah, and you brought up Santa Barbara. I think Santa Barbara is like at least 2 of their zip codes is in the top 10 most expensive places to live in the world.
Yeah,
even where I'm at in San Luis Obispo, it's pricey. Anywhere on the California coast is going to be pretty pricey.
Yeah.
So you do have to, the cash flow numbers and the cash on cash returns, IRR, whatever, whichever metric you want to look at. It doesn't really make a lot of sense for a lot of single family homes, here on the coast. And so we are talking about investing out of state. And I think that does scare a lot of people. Um, and you have to really coach them through that. You have to break that down, that fear. Why is that intimidating for you?
Yep.
Well, what if something breaks? Well, you can hire a property manager. You could have have a couple of
Yep.
handymen women that that you can dial.
Yep.
There's and then well, what if a tenant evicts and I can't fill it? Well, then let's start talking about what are the other alternatives. Well, if we're looking at markets that have universities, if they have hospitals, if they have a lot of job growth, you look at the census data, right? And you look at the average age of folks, the income levels that they're at. There's plenty of data to go to find regions where if you do deal with a vacancy issue, which you're trying to solve right off the bat by looking at all that census data,
Mm-hmm.
but two, well, maybe we look into midterm rentals, short-term rentals. If there's a lot of great hospitals nearby, maybe they have a lot of travel nurses and doctors. So maybe it would be more advantageous to have this as a midterm rental than the long-term rental. And then you have more opportunities, to fill it and obviously to make more income as well. So, I think it's just breaking down what is that fear, and then let's talk through what we can do to solve that. But in California, as I just mentioned, you're not going to get the numbers that are really worth getting into real estate investing in most spots when we're talking about like a Santa Barbara or something. So let's look at other markets.
Yeah, you bring up a couple of really interesting points there. First of all, you can't really build a team until you get in the game. Like you have to get a property, you have to have either a property manager or someone that's doing maintenance for them, and you build relationships, you build the time. That's part of being a real estate professional, is you're basically building a business around a team that can help you support those investments. So if you've got a realtor or something like that can help and make introductions, that's great. But you really got to get in the game to build that team, and over time it'll happen. And then the other thing you mentioned that's really important, I think, is we have this what's called a real estate report card, and it's through a service that we use called MBS Highway, and it actually breaks down demographics, unemployment rates, average income for the community. Are incomes going up or going down? Are jobs being created or jobs being taken away from the market? How many household formations? What's the ownership rate in that particular municipality? And it really gives you a comprehensive, I'll call it a dashboard of an area that you might not know living across the other side of the country. And I think that if someone is not doing that sort of type of research before buying out of where they're familiar, they're probably making a mistake. But boy, you can really, if you've got a little bit of an insight on a team there on the ground, and you've got a good dashboard for the real estate, your probability of making a mistake is pretty dang low.
Yeah, exactly. And that information that you provide is completely invaluable. But once you start looking at that, that's really where that fear breaks down, is because you will know that market so well that you will have the utmost confidence in it. And if you don't have the utmost confidence in it, well, find another area. There's plenty of
Right.
markets out there. We're seeing these trends of folks moving out of certain regions like California and moving into other regions because there's a lot of, and Salt Lake City is one of those. There's a
Yep.
lot of beautiful regions in this country that I think a lot of people didn't realize existed before. But people are finding out, and they're starting to move to these areas. And so when you look at like the Sun Belts, Utah, the Mountain West,
Boise, Idaho is blowing
Boise,
up.
Bozeman, Montana,
Yeah.
a lot of these places are being discovered now. They are extremely beautiful. And so when you see that data of the population growth coming in, the job growth coming in, corporations moving offices to new locations,
Yep.
and new, let's say like new Amazon plants, nearby, or distribution centers.
Yep.
And so when you see that data, you can be fairly confident in it. And then I always encourage people to do one more than that, and that's after all of that data has been done, go visit it. Go actually travel to that place. It's a tax deductible expense. You got to have documentation that shows that you went and looked at properties. But if you do that over a long weekend, so say you schedule a meeting on a Friday and schedule a meeting on a Monday, now you had a business purpose to be there over the entire weekend. You basically get a more or less a tax deductible vacation, and you get to experience what that particular economy and what that particular city feels like.
Yeah.
And I think that's the ultimate, then pull the trigger. If all the boxes are checked, pull the trigger.
Awesome, man. That's great sounding advice. And I think it's a perfect segue. One of the reasons why I have primarily focused on investing in real estate, although I do have, a portion of my portfolio that is in some stocks because I don't want to fall into the trap like my grandparents did. But one of the reasons I focus on that is because of the tax benefits and tax efficiency, and self-employed people, independent contractors, the realtors that you serve. This is one of the most important reasons to invest in real estate. So let's talk about some strategic tax planning. Why don't you walk us through your favorite tax saving strategies, any recent tax changes you think we should be aware of, and what benefits investing in real estates have in that regard?
Yeah, there's so many great tax strategies that are there to be used. And I think a lot of people first need to look at tax strategies differently. I think a lot of people think there's these loopholes for the rich, and they're not. People need to realize there really aren't any loopholes per se. They're all intentional.
Right.
It's designed to incentivize people to boost the economy. Well, that's what a lot of investing in real estate is for. You're helping boost the economy. Investing into your business, well, that's boosting the economy, and then you're also providing jobs. The government wants to make sure that you don't become a burden to them, meaning that they don't have to then create stimulus packages around helping you out. Retirement plans exist for that reason, because they know if you run out of money, you're going to go onto the welfare system. Well, the welfare system costs money. You have to assign jobs, within the government to do that. You have to assign money to do that. And so these tax strategies are there. It's just people need someone to help them in real time, in the moment, know the tax strategies, but then when to take advantage of them.
Mm-hmm.
And so, yeah, I think one of the most overlooked tax strategies or tax benefits is the health savings account. I preach on the health savings account all the time. It is one of the only if not maybe like only one of two or three retirement or investment vehicles that the government allows to be triple tax free. So that means money going into it is a straight reduction off of your income. You can contribute for this year as a family up to $7,750 for 2023. That is. The money goes in is a reduction on your income. You can invest that money. I don't think people realize you can invest money within an HSA into stocks and bonds, you can even what's called self-directing it and buy real estate in your health savings account. Cryptocurrency, whatever you want to invest in, but then you can invest that money as tax deferred. So you're not paying money on the gains within the account. And then as long as it comes out for qualified medical expenses, which is extremely liberal these days. I mean, it can be everything from acupuncture to massage therapy, so long as you have a doctor's note that says you need it, prescriptions. And so then it comes out tax-free. It's a tax savings that people don't realize is there. A strategy, if you're younger and you don't have a lot of medical needs, is invest that money, have it grow for a 20-year period, because when you really need to use medical expense money is when you're retired, right? So just treat it as like another retirement investment vehicle, and have that, have it grow, say $100,000 over 20 years, and use that $100,000 to pay for your medical costs. So it's basically just using money that you never had before. So that's a big one. For self-employed individuals, a SEP IRA, or even better, a solo 401k. Now, you can't have any employees outside of a spouse, but if that's the case, then you can have a solo 401k. It allows you to contribute the maximum regardless of what your income is. So if you have good household income, but maybe yours isn't quite as high for that particular year, then you can contribute up to, I think it's like 63,000. And I only say that because we're in that awkward time where I have to know 2022 numbers and 2023 numbers. And it's changing every single year. Um, and then in real estate, investing into real estate, well, not only if you qualify for the real estate professional status, which is great, and there's a whole hour test limit on real estate professional status. It just means that basically you are a real estate professional and that's what you do for your career. And then any money or investments that you make in real estate can go to offset your entire household income. So your spouses too.
And just for clarification, that's not like realtor activity. That's a real estate professional is managing your investment properties, correct?
Managing your investment properties. I mean, it goes so far as even if you were involved in the debt processes for so like say you're a private money lender, it's really a pretty broad definition of what real estate professional status means to them.
Got it.
But they want to know that you're doing it more than any other job. So that's basically the premise of it.
Yep.
But then there's things like bonus depreciation. So bonus depreciation is a really big one. It started its phase out at the end of 2022. So there's really an important time period now to utilize it to its advantage.
Yep.
But basically, you can take, if you have a real estate investment, a piece of property, and let's say you put in new flooring across the entire house. You went from carpet to the hardwoods. That floor now can be depreciated in a single year as opposed to over the life of the house, which is 27 and a half years. So it can really be a big tax advantage. So basically, if that was, say, $15,000, that $15,000 is a direct reduction on your income. So that's money that you don't owe in taxes.
That's massive. And I think we should park there for just a minute because, if anybody is self-employed and they're having a hefty income year, they need to really pause and think about if they or their spouse could qualify under the IRS terms for a real estate professional. And you either have investment properties and you haven't depreciated them to the full extent, or you're interested in investing in real estate so that you can offset some of your income and taxes. Basically, what this bonus depreciation is this came under the Tax and Jobs Act of 2017. What was that act called, Mike?
Tax Cuts and Jobs Act.
Jobs Act. Yeah. Okay.
Yeah.
And basically, instead of depreciating a property over long periods of time, you could subdivide the different types of asset inside of a property. So, like Mike said, if you have carpet or flooring or refrigerators that are less than the whole amortization of the depreciation cycle, you could pull that forward and take a massive tax deduction in a single year. So I've seen clients offset, and in fact, I have completely offset my entire income from that bonus depreciation. And as Mike is saying, that's starting to phase out. I think in 2027, it's going to be completely phased out, correct?
Yeah, it's going to be, in 2020, starting in 2027, it'll be completely phased out. So it's dropping by 20% increments until that time. Yeah. But yeah, it's a great way to take advantage of some massive tax savings. And in addition, you're really just putting more equity into your property. So I think a lot of times people say, yeah, but it costs me money to save the taxes. Well, that's the beauty of real estate, right? Is forced appreciation. You actually have control to appreciate your property, unlike a stock. Say, let's take Coca-Cola. If you were to invest into Coca-Cola, you really have no control. Your shares are not gonna benefit the company so much that you're gonna see immediate profits, right? But you can do that with real estate. If you put I'm even blanking at linoleum, hardwood, or no,
laminate,
vinyl luxury hardwoods, or whatever the new trend is.
Yeah.
But putting in the new flooring into the house as opposed to carpet, let's say that cost you $15,000 to put in that hardwood, but that actually might have appreciated the house by $40,000.
Right.
depending on the market that you're in. So I wouldn't look at tax savings as a cost, because I think that's the pushback a lot of times is, well, that means I got to spend money to just save in taxes.
Well, remember, when you invest in real estate, you get paid in 5 different ways, right? First and foremost, on my list, at least how I rank them, is cash flow. So to your point, yes, there's appreciation that you're going to get because you're going to increase the value of the home, but you're also very likely going to get an immediate increase in your cash flow, right? So if you think about the 5 ways you get paid, there's cash flow, there's appreciation, the value of the home going down, up,
Yep.
the amortization, which is the amount of the mortgage going down if you have indebtedness on it. You've got your depreciation, which is the tax savings that if you qualify as a real estate investor, and I think we're going to get to one other potential way that you can depreciate real estate. That's a way you get paid by owning real estate. And then I add a 5th that I call rent inflation. And I know you could argue that, well, wait a minute, number 1's cash flow. Isn't rent inflation just cash flow? Yes, but very few real estate investors think about the massive increase in rent over long periods of time. I'm talking about 20-year, decades, periods of time. And I really believe you have to divide that out and look at it as another way to get paid. Because, for example, we have a property that, we started renting it 22 years ago at $315 per door. It's an 8-plex. And now they rent for $1,500 a door. Like, you really got to think about that long term. Do you do any analysis and multiples of that when you're showing people real estate investments, by the way, Mike?
I do. I have various different spreadsheets where I basically throw together their cash on cash returns, internal rate of return. I also have a spreadsheet that I created that shows the difference if they were to keep their investment as a long-term rental versus a short-term rental. But yeah, they basically show the inflation or the rent increase year over year and how that compounds over time. Yep. And I think that's really, really great that you bring that up, because I always like to bring up a real estate investment versus like a stock investment, right? Because that's how people kind of think of the two.
Right.
When you think of a stock investment, there's usually a dividend that pays on it. Mm-hmm. So you get a percentage of income stream from the stock. The difference between that and real estate, and so it's kind of like a dividend that you're, right? And when you have a stock, that company controls what the dividend is. You don't control it. They can increase that dividend. They can decrease that dividend. It could be at 2.5%, they jump it to 5. It could be at 2.5% and they jump it to 0, because basically the company can no longer afford to pay it out. And so the difference there is when it's real estate, you have control over the dividend that you receive. You can increase it at a normal CPI rate, a consumer price index rate, or whatever the rate of inflation is going to be. Mm-hmm. Or if you decide that the market can really support it, you can increase your rent by 4%, 5% per year. You have control over that.
Yep. Yeah. I've gotten just recently, Mike, working towards my first or put into rent, I should say, our first midterm rental. And you're talking about having agency over what to do with your real estate investments. This is a 22-unit apartment building we own in downtown Salt Lake. And we're getting about $1,500 a month for these 1-bedroom, 800 square foot, nicer units. We just did a big remodel on this building a few years ago. And we realized that if we furnish those units and make them completely move-in ready, it's a cost of about $6,000 to $7,000 for furnishings and silverware and all the things you'd need for your houseware. But we can increase the rent by about $800 to $900 a month. So if you do the math on that, you're going to get paid back in less than a year. And then you have that long-term additional cash flow. And that's the beauty of investing in real estate, is you get to make those, you have full dominion over your decisions of what to do with that. Hey, do I want to pull equity out? Do I want to refinance to a lower rate? Do I want to kick those tenants out and then improve the property and get a higher rent? Do I want to switch over to a midterm or a short-term rental strategy? So you have complete control, where at a in an index fund, you're just a bystander, if you will.
Yeah, exactly. Well, and to your point, I actually did that with one of my real estate investments, which also happens to be in downtown Salt Lake City, in the Avenues neighborhood of Salt Lake City. And it was a long-term rental when we first bought the property. I think we were cash flowing maybe $500 per month, which is, it's not terrible. But we also had the water heater go out. We had to do redo the entire irrigation on the property, and then we zero scaped it. But then everything went out at the same time, and it was costing a lot of money. Great news is those are long-term investments. Another good news is I can bonus depreciate.
Yep.
Also, I'm also forcing appreciation in the property. So what seems like a really terrible thing wasn't that terrible. It was actually a lot of benefit. But having said that, we decided then we were going to convert it to a short-term rental because we wanted to be able to create a little bit more income stream there. So we've converted it to a short-term rental now, and it far exceeds that. We're probably, I don't know, 2,000 to 3,000 per month over what our mortgage is. And so it's done significantly better. Having said that, we may have to pivot again at some point, because short-term rentals are fantastic, but there is risk in it, because the risk lies in legislation and whether or not the city ordinances are going to allow Airbnbs. In Salt Lake City, they haven't actually come up with a determination. They're not really doing anything about it at the moment, but they probably are, and it may not be friendly in our favor. So at that point, well, we'll just keep all the furniture in the house and we'll convert it over to a midterm rental. There's a hospital right there, and there's probably a lot of travel nurses and doctors. There's a whole city right there where there's actually a lot of job growth. And so people need places when they're going on project-based work events for, say a month at a time. So there's flexibility, and you have to be willing to pivot. But that's the great thing is you can make those decisions.
Yep. Yeah, absolutely. You bring up an interesting point. We talked about, if you want to use the bonus depreciation and have the full tax advantages, you need to be able to qualify under the IRS code for a real estate professional. But there's also another ability to qualify for that, as I understand it, under the material participation definition. And so I assume you're familiar with that. Can you explain that to us a little bit?
Yeah, so there's three numbers to really remember. There's 750 hours, 500 hours, and 250 hours. The 750 hours is really just being involved in the industry or in the real estate space. 500 hours actually materially participating. This is per year. And basically that means that you're actually involved in the decisions of the business. Now, that doesn't mean involved in the property itself, just in the decisions of the business. So that could be just the oversight management of it. That doesn't mean you can't have property managers or house cleaners. You can still do that as long as you're the one making those decisions. So with a short-term rental, they call it a short-term rental loophole. Again, we already had the conversation on loopholes. It's just it's the material participation rules. Yeah. And so when you have a short-term rental, and let's say you are doing the management of the short-term rental yourself, so you're the one responding on Airbnb back to the guests, et cetera, there is a lot of hours that go into that. And so it is presumed, and you have to have the documentation, but it's presumed you're going to meet the hour requirement needed for the material participation, because short-term rentals have turnover every 3 or 4 days, versus a long-term tenant who's in there every 12 months, and he may call you 6 times in the year. Right. And so you may not have as much participation in that business.
Yeah. Yeah. So the takeaway is, we work with a lot of busy entrepreneurs, a lot of busy medical professionals, and they may not qualify under the terms of a real estate professional, which would mean they couldn't take advantage of some of these tax benefits. But if they practice short-term rentals and they meet the code or the definition of material participation, then perhaps them or their spouses could qualify for those additional tax benefits without meeting which is a less stringent, less involved amount of participation than you would need to qualify for a real estate professional. So that's a second, we're not going to use loophole. That's a second
The reason why I steer away from loopholes, again, I think it gives people this false assumption of like they can never be involved in any of these strategies because that's only for the rich. It's Look, we need to get that out of our head. It's for anybody and everybody to use.
Yeah, really well said. And by the way, you're doing what the government is rewarding you for being involved in this industry. It's not that you're defrauding the IRS. You're actually doing what the government is asking or giving a benefit or reward for engaging in that activity.
I think there's this fear that people are going to be slapped on the wrist when really the IRS is saying thank you because you're helping to stimulate the economy. The goal is to keep us out of recessions and keep our economy one of the greats in the world. And so you're doing everybody a favor. And I think that's the mindset shift that people need to make.
Nailed it. That's exactly right. Okay. So we've touched on some different tax strategies here. I think it'd also be helpful in terms of entity formations. There's a lot of different ways to hold title to make sure that probably you've got the right tax efficiency, but probably more important, the right asset protection so that you protect yourself from a liability standpoint. How do you advise people to structure their holding entities, Mike?
Yeah, and again, it goes back to the fear. For all those real estate investors that are just getting started or wanting to get started, we're talking about breaking down the fear of how real estate actually can work out into your favor. But there is actually real risk there, right? We live in a litigious society. People sue each other, and so when you own a property, you really want to protect your liability and what you would have to pay. And so first thing I want to comment to is homeowners insurance policies. So really making sure that you have a solid homeowners insurance policy that's going to help protect you. If it's a short-term rental, a lot of mistake people make is just having a regular long-term rental homeowners insurance policy. You have to have one that specifically outlines the ability to have short-term rentals and people in there for shorter periods of time. So that's protection number one.
Big takeaway.
Beyond that is LLCs, right? So you want limited liability. When you have an LLC, people can only sue you for the equity that you have in that particular property. So each property should have an LLC, its own separate protection. Then people can only come after the amount of equity you have in the home. So it's not just the home itself. Say the home is worth $1 million. But you owe $675,000. Well, the difference there between the million and the 675 is really what they can come after you for. And then they wouldn't be able to attack any of your other assets, your other properties, bank accounts, et cetera. So you want that limited liability protection. If you own multiple properties, then yes, I recommend LLCs for each particular one. And then there are other structures, but depending on the state that you're in, something like what's called a series LLC, where basically one parent LLC owns all of the sub LLCs, and that just makes life easier. There's less paperwork involved in that. One of the things is and I said state dependent because, for instance, California doesn't recognize that. So there's certain states where they just won't recognize that kind of structure. But you want to get as much protection as you can. Beyond that, something that's extremely inexpensive that people should look into is something called an umbrella insurance policy. So this is now the ultimate layer of protection. So you've got the homeowner's insurance policy, then you have it wrapped into an LLC, and then you have what's called an umbrella insurance policy. Anything that isn't covered by the homeowner insurance policy, then the umbrella insurance policy will drop down and cover any excess. So you can get something like a $2 million umbrella policy for probably $45 to $90 a month. And it's well worth having that additional protection. And it goes beyond just your houses. If you got in a car accident and your car insurance didn't cover enough, the umbrella policy drops down to cover any excess that's there. So it's very, very beneficial.
Great takeaways. Just getting a little tactical on that. What are you seeing the costs of? Because I'm thinking, the reason why somebody wouldn't engage in going and getting LLCs set up is they're worried about cost, or they don't know where to go. And it's just kind of a black hole that if they haven't, investigated, they may not know where to start. So what advice do you give people around what they should pay? And do you have relationships with people that you recommend?
Yeah, I do have relationships with people I recommend. I'm happy to give any individual a recommendation on that. I do think beware of Google, and that's almost really with anything, because the people who pay the most are shown the most, right? And so a lot of those are some of these scam LLC companies that they try and get you into something either that's not providing you the protection that you thought it might, or it's so overly complicated
Yes.
and complex that it wasn't necessary at all.
Yeah.
So I'd be wary of the people who say, invest in this Nevada LLC because it's going to do so much for you. Well, the Nevada LLC isn't recognized in states like California and some others, and so there's some nuances there. I personally set mine up with a company called Royal Legal. I think they're a part of the Bigger Pockets community, or at least they sponsor a lot of Bigger Pockets stuff.
Mm-hmm.
And they did a good job. I think you still need to be a little bit, if anything is costing you over a couple of grand and it sounds so complicated you don't understand it, then run.
That's the yellow flag right there. Exactly.
Yes.
Yeah. I went through a pitch one time from a attorney firm that was exactly what you said. Like you needed a decoder ring and an Etch-a-Sketch to try to sketch this whole thing out or map this whole thing out. And at the end, I was thinking, how much does this cost? And they were like, and we can set this up for you for only $18,000. So I was like, okay, yeah. I don't think I'm going to be sending clients your way.
The first people I came to, they were recommending what's called a Delaware statutory trust.
Yes.
And it was and first, it is a good strategy for certain people. You have to be in the right circumstance. For myself, with at that time 2 investment properties,
overkill,
Delaware, it was way overkill, and they wanted I think it was something around $9,000, and just I said no thanks, and then called the next people.
Yep, that's a great litmus test. I love that. Mike, this has been a lot of fun, man. Let's wrap up with one final question for you, if we could. What myth or misconception do you see out there about either finances, investing in real estate? But what's one myth that you see that's commonplace that you'd like to disrupt for us?
Yeah, that retirement is the holy grail of what we're all trying to accomplish. I think there's a lot of thought that needs to go around that. First of all, there's a high correlation between when you retire and when your mental strength starts to decay, or starts to at least go away. And so I think we need to rethink what retirement is. I read this great book. It's one of my favorites. It's called The Happiness Equation by Neil something. You'll find it if you look it up. It's a blue cover. And in that book, he discusses when retirement was invented. And it wasn't until, I think it was somewhere around the 1940s to 1960s, Germany had this really, they had a really big working class. It was basically like our baby boomers. And they were working until late ages, but these young people who were coming out of universities and just coming out of their education couldn't find jobs because there were none. So their government incentivized the baby, let's call it the baby boomer generation, to retire by putting together these retirement packages. And that was how retirement was created, because they wanted to give the younger folks the ability to come in and get jobs. And so when you think about that, it's just interesting that retirement hasn't really been a concept for that long. And through so many generations in history, retirement wasn't ever a thing. And so I just think that people need to rethink what life at perfection looks like, because it may not, you might get bored of playing golf every day after about the first 2 months.
Man, I tell you what, way to come full circle on your initial comment around what does what does perfection look like? Is that the question that you said earlier?
What does your life at perfection look like?
Yeah, that is such a great question. And I couldn't agree with you more. Retirement for me means 100% showing up to participate in activity and work on my terms. I don't want to opt out of those things. I still want to be involved and use my brain and have value to planet Earth and humanity, but I want to be able to do so absolutely on my terms. And I love how that kind of whole mindset fits into real estate investing, because you may decide to leave your main hustle at some point to only then go on to spend more time managing your real estate investments and making your side hustle your full-time gig. And that to me is what perfect retirement looks like.
Yeah, exactly. I would agree. And that is something that people need to look at. Real estate investing is sort of like a job. It's just a job you don't have to work as hard at, and you get to control all the factors in it. So it's probably a lot more enjoyable than someone barking orders at you. And so that might be your life at perfection.
Well, brother, I think that was a beautiful bow to wrap around this podcast and a great way to end. So thank you so very much for joining me and sharing so generously. How can people find you? I know you've got a great blog. Where should people look for you?
Yeah, my website is LifePointFD, is in lifepointfinancialdesign.com. I'm fairly active on Instagram, so that's at Michael, Michael .b as in boy .Metzger, which is Metzger. And you can find me on Instagram, Michael.b.Metzger, or you can email me, Mike@lifepointfd.com.
Mike, thanks, man. Appreciate it. It was a great conversation. Appreciate all the value and knowledge you dropped, and hope to have you back sometime in the future on the Infinite Financial Freedom podcast.
I appreciate it, Josh. This has been great.